Fundamental trading is the art of looking under the hood. You aren't trading a ticker symbol. You are trading a business. You believe the market is a giant voting machine that occasionally gets the math wrong. You ignore the flashing red and green lights and look at the truth of the company's bank account. You want to buy $1 for 75 cents. Think of this like buying a used car. A technical trader only looks at the paint job and the current speed. A fundamental trader opens the hood, checks the oil, looks at the service history, and calls the previous owner. You don't care if the car looks fast today, you care if the engine is built to last 10 years. You dive into the balance sheet. You look at revenue to see if people actually like the product. You look at net income to see if the company is actually keeping any of that money. If a company makes $1 billion but spends $2 billion to get it, the fundamentals are trash. You track interest rates because they are the gravity of the stock market. When rates go up, stocks feel heavier and harder to lift. You are playing the long game, waiting for the rest of the world to realize a company is worth more than its current price. You are the detective of the stock market, looking for clues in quarterly reports that everyone else was too lazy to read. Reversal trading is betting against the crowd at the exact moment they realize they've gone too far. It is the most dangerous and rewarding style. You are looking for exhaustion. You wait for the price to move so fast in one direction that the buyers or sellers simply run out of breath. You aren't looking for a trend, you are looking for the end of a trend. Imagine a giant rubber band. The further you stretch it, the more tension builds up. Eventually, the band can't stretch any further. At that exact microsecond of peak tension, the band snaps back in the opposite direction. Reversal traders live for that snap. They don't want the stretch, they want the recoil. You look for signs of panic. In a downward reversal, you wait for capitulation, the moment everyone gives up and sells at once. This creates a V-bottom. You use tools like the RSI to see if the market is overbought or oversold, which just means the rubber band is dangerously thin. You look for divergence, where the price keeps going up, but the energy behind the move is dying. It's like a car flooring the gas pedal while running out of fuel. You know the crash is coming, so you position yourself to profit from the U-turn. You are the contrarian, entering the room exactly when everyone else is running for the exit. Trend trading is the path of least resistance. It is the simplest and most effective strategy for most people. You don't try to predict the future, you just observe the present and follow it. If the market is moving up, you buy. If it's moving down, you sell. You don't ask why, you just ride the wave until it hits the shore. Think of trend trading like an escalator. If you want to go to the second floor, you don't climb the wall. You just step onto the escalator that is already moving up. As long as the motor is running, you just stand there and let the machine do the work for you. You don't get off until the stairs disappear into the floor. You use moving averages to smooth out the noise. The price might jump up and down, but the average shows you the true direction of the motor. You look for higher highs and higher lows. This is the heartbeat of a healthy trend. You don't buy when the price is at an all-time high. You wait for a pullback. You wait for the escalator to pause for a second so you can step on at a better price. You use the 200-day moving average as your line in the sand. If the price is above it, the sky is blue. If it's below it, the storm is here. You aren't trying to be the smartest person in the room. You're just the person following the biggest crowd. Breakout trading is about identifying a pressure cooker. You are looking for a stock that has been stuck in a cage for weeks or months. The buyers and sellers are in a dead heat, and the price is moving sideways in a tight box. This is consolidation. You aren't interested in the box. You are interested in the moment the box explodes. Imagine a racehorse behind the starting gate. The horse is jumping, kicking, and full of energy, but the gate is holding it back. Breakout traders are not betting on the horse while it's in the gate. They are sitting with their finger on the button, waiting for the gate to swing open. The second that horse clears the metal, you jump on its back. The gate is the resistance level. Every time the price hits it, it gets knocked back down. But each time it hits, the gate gets weaker. You look for volume to confirm the move. If the price breaks the gate but nobody is cheering, it's a fake out, and you get out immediately. If the volume is huge, it means the entire stadium is betting on that horse. You enter the trade at the moment of highest volatility, expecting a violent move away from the cage. You aren't looking for a slow climb, you are looking for a launch. Momentum trading is about the hype train. You aren't worried about value, and you aren't worried about the gate. You are worried about speed. You want the fastest moving object in the market. You believe that strength leads to more strength. You buy stocks that are already up 20% because you think they're going up another 50%. Think of momentum like a snowball rolling down a mountain. It starts small and slow, but as it picks up snow, it gets heavier and faster. By the time it's halfway down, nothing can stop it. It doesn't matter what's inside the snowball. All that matters is the gravity and the speed. You want to be on that snowball until it hits the village at the bottom. You use the RSI and MACD to measure the velocity of the move. You look for stocks that are gaping up on news. This is the fuel for the move. You don't hold these stocks stocks for years. You hold them for as long as the speed is increasing. The moment the snowball starts to slow down or hit a flat patch, you jump off. This style requires lightning-fast reflexes. You are trading the fear of missing out of other people. You are the shark following the blood in the water. Chart pattern trading is based on the idea that humans never change. Fear and greed create the same geometric shapes on a chart over and over again. From the 1700s to today, you are looking for the visual footprints of big investors. You are decoding the psychology of the crowd by looking at the shapes they leave behind. Imagine you are looking at the stars. To a normal person, they are just random dots of light. To an astronomer, they are constellations, the Big Dipper, Orion, the Archer. Once you see the pattern, you can predict where the stars will be in 6 months. Chart patterns are the constellations of the financial markets. You look for head and shoulders to see a trend dying. You look for cup and handles to see a market taking a break before a massive surge. You look for triangles, where the price is getting squeezed into a corner until it has nowhere to go but up or down. These aren't just lines on a screen. They are the battle maps of millions of traders. You are looking for confluence, where a pattern matches a support level and a volume spike. You are the historian of the market, using the past to draw a map of the future.